So we got the much anticipated CPI or Consumer Price Index inflation reading. We've got some housing market updates from Altos Research. What did Ken McElroy do yesterday that was pretty cool? I want to give you a special offer at Wealthcon with Ryan Pineda and team that I'm speaking at. He is giving the One Rental at a Time community something special. And let's close with Fed rate cuts, rate increases. Where do I stand? All things the Fed. So let's just jump into it. What happened? We've been waiting for CPI inflation reading for about a month. Remember, last month, the inflation readings at all levels were above expectation. There was a talk track that it was just January adjustments and nothing to be afraid of. Well, we just got the February reading and 3 out of the 4 metrics were higher than expected. I think most concerning of the 4 metrics that I have yet to hear the media talk about is headline inflation has broken trend. All right, what does that mean? Well, we have been on a downward trajectory for the better part of a year, probably 14 months. This month, headline inflation, unfortunately, has gone up. It went up 0.1% from last month. Last month reading, headline inflation was 3.1. This reading was 3.2. It has broken trend. We have been talking for better part of 2 years that inflation had 3 parts. There was goods inflation, there was services inflation, and there was housing inflation. We have undoubtedly seen most, if not all, of the deflation in goods. Services inflation is proving sticky. And obviously, shelter inflation still has not rolled over. So what are the numbers? Get to the numbers. Well, we're going to look at headline month on month first. Expectations were 0.4. Last month was 0.3. So again, the expectations were for them to go up slightly, and they did. That was the one metric of the 4 that they got right. Core, it was expected to go up 0.3. Last it was 0.4, and it went up 0.4, so more than expected. Lastly, year-on-year headline and year-on-year core. Headline went up 3.2, again exceeding last month, breaking trend, not good. And core still continuing, although ever slightly down. Last month was 3.9. This month was 3.8. So I've had a little bit of time to dig into the numbers. Not surprising, about 70% of the inflation was shelter and energy. Food was flat for February. So again, we see now that shelter inflation is going down. It was 0.6% last month, 0.4% this month. It was 6% year on year last month. This month, 5.7%. Shelter is going down slower than most, including myself, expected. I had thought we would see meaningful shelter drops by the end of the year, and that has not happened. It is still coming, although be it slowly, right? You and I both know that rents are not going up 5.7%. That hopefully is obvious to everyone, including the Fed. They know that their shelter mumbo jumbo is messed up and inaccurate. So what does this mean? Let's jump to the end. Let's talk about the Fed rate cuts. The market has gone anywhere from expecting 7 rate cuts to 2, currently calling 4. They were expecting a rate cut by June to the tune of 70%, 70. That was as of yesterday. I do not know what the reading is this morning. Well, what I can tell you, in my opinion, with a fair amount of conviction, that of course we are not having a March rate cut. That is lunacy to think we will have a rate cut in March. Now, I believe with a fair amount of certainty that a June, yes folks, a June rate cut has left the building, thus making July the likely rate cut. And again, I think I've said this before, but let me be clear. I think the Fed has to cut in July, or they can't cut in September. In my opinion, the Fed, unless the economy is cratering and we have just horrible events in banking, they will do everything possible not to cut in September. September is the last meeting before the election, and they do not want to be seen as looking at rate cuts coming. Just saw a note about rate increases. I know one of my weekly guests, Mr. Dan Bird, keeps saying that rate increases are coming. I too think that is lunacy. Again, yes, headline inflation is up, but again, 70% of that rise is shelter. And hopefully we've all talked about why shelter is lagging, and the Fed knows that. So as I shared with Dan, I kind of chuckle at the idea that the Fed will increase rates in March. But hey, I suppose you can always say anything is possible. So there you go. No rate cut in March, and for the first time, I'm saying no rate cut in June. That is because inflation is proving stickier and really more broad-based. So let's get into Altos Research. Altos Research, Mike Simonson is wonderful enough to put out data on Monday on X or Twitter, and I've captured a few of those metrics. Again, if you want to stay up to date with what's going on, there is few, if any, better than Mike Simonson at Altos Research. We are seeing active listings increase. They were up 0.5% week on week. They are up 21% year on year. It will be very interesting if, again, I underscore the word if rates stay below 7% for the 30-year mortgage, do we see demand, right, marginal demand, come back to the market and surprise people? There are people talking about active inventory going up 40%. Again, anything is possible. I postulate that if rates stay below 7%, that marginal demand will come back and any marginal supply will be dwarfed. But who knows? The good news is we will keep getting data every week from Altos Research, and we'll be able to watch it. We did have 59,000 new listings. That was up 15% year on year. Price reductions were at 30.5%, again below historical averages. Asking price, $432, that is the median. That is up 0.5% week on week and 1% year on year. And we have 65,000 pendings, up 4% week on week and 1.5% year on year. Again, I believe the longer rates stay below 7%, the more demand that will be sucked off the sidelines. I believe we are on the cusp of having consumers who are frustrated and pissed off about 2 years of struggle coming to the housing market and just buying whatever. That is not a recipe for wise financial decisions. In fact, if it happens in mass, it can and probably will lead to a bubble. It's not good. I do not want to see consumers pissed off and frustrated making bad financial decisions. Always do the work. Don't overpay. Don't gamble. Don't be foolish with your money. Let's talk about Ken McElroy. First and foremost, folks, I want to thank all of you who sent me a note, a text, a DM, an email. Ken McElroy with his wife Danielle, put up a video yesterday of myself and, more importantly, Dana Dunford from Himlane talking about the accidental landlords. Hey, 00, thank you very much for the super chat. Thank you very much. I appreciate you. The super chat was very nice of you. But yes, folks, Ken McElroy and his wife Danielle sent out or played a video talking about accidental landlords. I believe they're right. I believe Dana is right. I believe that there are lots of folks, maybe some of you watching this, that are like, you know what? My 2.8% mortgage is an asset. I believe Danielle talked about one of her condos that came out and she had like a 2.7 or 2.8% mortgage. Ken was like, you need to sell this. Daniil's like, are you kidding? And Ken's like, you're right. You have an asset. Fix it up, rent it again. I do believe that we will see more quote unquote accidental landlords. What is an accidental landlord? Simply said, somebody that bought an owner occupied house and decided to keep it instead of sell it when they're ready to move on or move up. So again, that is cool. Let's talk about Wealthcon. So I don't know if you guys know this, but Ryan Pineda has invited myself and One Rental at a Time to speak at Wealthcon. I think this is a huge, honor. I think getting invited to speak at Wealthcon to 1,000 to 2,000 folks is an amazing opportunity, which I am thankful for. I am thankful for the opportunity to share what is One Rental at a Time. It is focus, it is daily discipline, it is about what is possible. And Ryan, yesterday at the end of our video, if you watched it, he gave you the opportunity to come with a 50% discount. So folks, if you live in Vegas, you need to come to Wealthcon. It's 50% off. The coupon code is simply my last name, Zuber, Z-U-B-E-R. You're going to get to hear a lot of speakers, including the folks that train Michael Jordan, Kobe Bryant, Dwayne Wade, Tim Grover. You're going to hear from Dan Martell and many, many others. Again, if you are coming, please let me know, because I would love to do coffee or lunch or something with the One Rental at a Time crew. Again, 50% off, just my last name. Go to wealthcon.org, and let me know you're coming, and I will see you there. Other things to look at. How about some crazy housing markets? Shout out Chester for sending this over yesterday. Chester sent out a note from a Resi Club article talking about the 5 most expensive and the least expensive markets. It was actually, I think, a list of 40. I'm just going to take the top 5 and the bottom 5, so shout out Chester for that. Let's start with the bottom 5. Birmingham, Alabama. You need to make $74,000 a year to afford the median home. New Orleans comes in at number 4 with the same number, $74,000. You make $74,000 in New Orleans, you can afford a median home. Cleveland, Ohio comes in 3rd place at $70,000. Memphis, Tennessee comes in next at $69,000. And the winner, and I want to shout out the financial firefighter in Hawaii. I believe he invests in this city. It is Pittsburgh. Pittsburgh. All you need to do is make $58,000 and you can afford the median house in Pittsburgh. All right, how about the crazy lunacy? 4 out of these 5 markets are in California, with number 5 being Seattle. You need to make $213,000 to afford a median home in Seattle. Shout out to the one and only Beth Traverso for being a top 1% agent there. San Diego, California comes in 4th at $273,000. Los Angeles at $279,000. San Francisco, $339,000. Folks, if you make $339,000 a year, why the heck are you living in San Francisco? I'm just saying. And then the most crazy, insane, frankly stupid market, San Jose, California. Yes, my backyard. You need to make now $454,000 just to buy a median home. Folks, that tech money must be good. That tech stocks, RSUs, it is wild that you have to make almost $500,000 just to afford the average home. Nuts. Just nuts. Alrighty, folks. Lastly, I want to shout out Ryan Nickel. Ryan Nickel came on the channel yesterday to share some amazing foreclosure. I shouldn't say amazing. They're amazing, but frankly, they're kind of like sad amazing, if that makes any sense. Sad, amazing details about 3 recent foreclosure folks he's trying to help. Folks, foreclosures happen all the time. It is not surprising to see that more and more folks are getting behind as job layoffs and financial decisions. But there's a lot of folks that just ignore it and they put their head in the sand. It is also really interesting to see how banks will do workouts and create seconds and sometimes thirds. The entire foreclosure market is disrupted given the forbearance and all of that. So we are seeing undoubtedly more filings, but people in the doom camp do not understand. The doom camp likes to talk about 30 and 90 days late. Folks, let me be very clear. You need to be talking about 500 days late. We need to be talking about 365 days. The importance of watching 30 and 90 day lates is insane. It is old news. Last cycle, you could not get help until you were 90 days late. So you know what? Track 90 days late. Today, you're going to get help. You're going to get 6 months of forbearance with a couple clicks of your mouse. So again, we need to be talking about 1 year, 1.5 years. Again, the last cycle, we had cities like Las Vegas that averaged 1,000 days. So again, don't be dissuaded, don't be discouraged, don't be afraid of the doomers talking about a spike in 30 or 90 days late. They are just producing porn to distract you. Until they start talking about 1 year, it's not even around. This is talking about owner-occs, of course. This is not investor. This is not DSCR loans. These are owner-occupied loans. Folks, I want to have you an amazing day. Again, thank you so much for sending me those notes with Ken McElroy's link and timestamp. That was very thoughtful of you. You all are wonderful. Again, if you want to be a part of One Rental at a Time, I'm giving you a unique opportunity. You can buy the course, How to Get Started One Rental at a Time, for $3.99. And I will give you, as a nice bonus, the recording from the Vegas event and the 21 podcasts. If you have that already, I will give you something else. Perhaps I'll give you the 10-day workshop or whatever. I just want to thank you for being a part of the community. And again, remember, join the Facebook group. The Facebook group has nearly 2,000 members in it. They are doing the work. They are networking. They are all going through the struggle, right? They're all going through the first 5 years. They are there to help. They are there to listen. They are there to give advice. That community is worth just the cost of the course by itself, in my opinion. Folks, have an amazing day. Take care. Later.